Hello and welcome to Trading Mantras. Today we will explain psychology behind option buying and why many option buyers lost money. The most common way in which traders lost money is by buying calls when they think the market is bullish and buying puts when they think market is bearish. Usually what they do, they buy calls if it is going up and they buy puts if it is coming down. Okay. More often, most of the traders buy OTM options. Here the real problem with that. Suppose Nifty is at 17,800. Okay. Here you buy 18,000 strike price call option. This is 18,000 call option CE with 100 rupees premium. 17,800. Okay, 17,800 spot price, and you bought C of 18,000 with premium of 100 rupees. This means that your option starts making money at 18,000. Means if the price reaches 18,000, then only your trade will turn into positive. But you start break even only at 18,100 as you have paid 100 rupees premium for the option. That means your break even is 300 points away from the spot price, right? To be in the profitable side, there are 3 points you must consider. First point, you must be right on price direction. Right? It must go in favor of your direction, price direction. Second point, you have to be right in a big way, like 300 points upside rally must be happen. Third point, time. You must be right within a short period of time. Whatever the trade you have taken should be done within a short period of time. Then only you will be in the profitable. Okay, else your trade will turn into negative. If any one of these fails, your trade setup will fail. Means you will be in the loss side only. Okay, even if the market doesn't move against you, stays flat, as the contract approaches expiry, the premium drops along with the time value. Here you see, Monday you bought your call option. Tuesday didn't reach, nearly reached your target, means 18,100. If you exited here, that's okay. If you didn't exit here, it keeps on approaching your expiry, and premium starts dropping along with the time value. Okay, option premium is nothing but like IV plus TV. IV plus TV in the sense intrinsic value and time value. The one certain thing is clearly reducing time value here, and as it is an OTM, so there is no intrinsic value obviously. This is the main reason why option buyers lose money. This is unlike trading stocks where you can potentially hold the stock forever. Okay, the above effect of time value gets exaggerated because most actively traded options contracts are at the money or out of the money, which have no intrinsic value. So if Nifty is at 18,000 calls and puts will likely be the most actively traded contracts. But this contract has just time value and no intrinsic value. And hence a high probability of losing money even without the underlying Nifty index moving against the trade, in the sense if it is not going against you, if it is staying flat even due to the time depreciation, time depreciation, your trade will be in the loss side only. Okay, even if it stays flat, you will be in the loss side only if it is approaching the expiry. Also remember that if you buy weekly expiry as compared to monthly expiry, time value reduces much faster for weekly expiry. For monthly expiry, you have enough time to take decisions wisely. Okay, if you are taking direction views or buying options, always trade monthly expiry only. If you don't have good time and good setup, means proper setup, suitable setup with good risk and reward. If you don't have that, then try to stick with monthly expiries only. And even if you can't sit in front of the system to monitor all your trades throughout the day, and if you want to be safe trader, then better to stick with monthly expiries only, which has more time value and hence higher odds of profiting as compared to trading weekly expiries. Weekly expiries has no time value and no intrinsic value. If you have taken out of the money options or at the money options, then chances of losing trades is very high if you don't have the proper setup. Okay, please remember those things. Keep in mind always. The next, averaging down by option positions is a very bad idea. Averaging, if price goes against you, is probably the biggest destroyer of your trading capital. Suppose while averaging down might work sometimes, disaster may just be one trade away. Like if you keep on averaging, like if the price is making like some like this, you understand what is this? This is the downturn. Like keep on making lower highs. You see, rejected here and made lower high and broken this support and again made another low high and rejected from top side and made another lower low. So if price making lower lows, then try to avoid averaging. Okay, make sure you go to the higher time frame and identify whether the stock or the price. Don't try to look identify these higher highs, lower highs in the index. Try to identify these higher highs and lower highs in the stocks only. Okay. If it is in the if it is making lower lows, then try to avoid such kind of stocks. For example, S Bank. The stock kept on falling like from above top levels to below 10 rupees levels. A few years back, many retailers invested into S Bank who had bought at higher prices, kept buying more, trying to average down, even selling other stocks to buy more of S Bank. The wealth destruction was immense. Okay, don't do such things. Don't average any stock if it's making lower highs and lower lows. Okay, always keep in mind. But averaging down can work sometimes when you buy stocks and the markets are in a long-term bull market, because you have time in your favor or the ability to hold on to the position forever. It is ludicrous to think of doing the same thing, buying options when time is constantly ticking against you. If it is like if a stock, some good stock going like this, so it is making higher highs, higher high, higher high, higher high. So this is the higher high. Keep on making a higher highs. In such stocks, you can try averaging it. If you bought here, okay, if it is coming down and made high, okay, and coming down, then you can add more positions here. If you bought here For suppose if you didn't enter here and if it is coming down and made another low, means this is the change in polarity level. So this is hitting this level and wait for the confirmation. Check 1-day chart and wait for 1-day candle should be green above this level, then take an entry and put stop loss below this level and ride the move. This is how you have to invest. Wait for the price to reach previous CIP level, then you can invest here. You can invest or you can hold it for a short term. One green candle means 1-day time frame green candle is bullish green candle is good enough for your entry by putting stop loss below this level. Okay, this is how you have to take entries in case of stocks. If you, in case of options, that is like foolishness to average your positions. Okay, it won't work. Better to take stop loss rather than waiting for so long. Okay, the right way to trade the markets is to never get overexposed to any trade that can cause more than 1% risk in one trade with your trading capital deployed. If you want to take more risk, then 3 to 5% is the high risk you can take. Beyond 5% risk is your it is like it can blow all your whole whole trading capital with no time. Okay, suppose if you have like 1,50,000, if you have 1,50,000, okay, then to trade in Bank Nifty, you should not lose more than 50 points in a trade. It should be around 1,200 rupees, right? Yeah, it should be around 1% risk. For risk, this is for safe traders. Safe traders. For risky traders, 3 to 5% means you can lose 3K to 5K. I don't recommend it to lose more than 3K. It's better to avoid 5K even. Okay. This is how you have to manage your risk. Always keep in mind, don't lose more than 1% with your trading capital in your trade. Okay, up to 3% you can lose in a day. Don't go more than 3%. You can blow all your trading capital with no time. Seriously, cut your losses quickly. Losses are easy to accept when they are small. As they get bigger, it only gets tougher to exit. If trading options with larger than say even 1% of your capital, having SL in place is very important. Suppose if one trade made like some 2K, if you kept on waiting, the price may come like this. It will turn into 2K. Initially it will be 2K loss, right? Then it turns 3K, 4K, 6K, 10K like that. Okay, it's very hard to take this much loss, right? Being a retail trader. So obviously big traders, they cut losses very quickly. They know how it will turn into that trade, how further if they waited for so long. So better to exit when the loss is very small only. Okay, even if you want to take more than 1% risk in option buying, then make sure you place that SL wherever you want. Okay, if it is going down, if you kept on shifting your stop loss like this, it will not be trading. It will be like some gambling. You will be blown up your account very soon. Okay. Many retail traders get stuck with hope when there is a loss that is too big to accept. Few retailers means many retailers, they can't accept the loss. If it is going against to them, if they bought here, if it is going against to them, they don't put stop loss and they wait to price to reverse this. and this levels to break upside like this. Okay, but it won't happen. It might come up to this level and it will go like this. They won't exit even here, and they wait with hope to happen. They just do trade what they think, not what they see. That is the biggest issue with the retail traders. They just hope with, they just wait with hope. The hope will turn into fear. The fear will cause them to blow up their accounts. Short term or intraday turns into long term positions just because of the loss. Most of the traders, retailers, what they do, beginners, if their account turns into the loss, like if they have taken trade here, it might broken the level wherever they have taken the trade, and they just shift the stop loss. Okay, and they may remove the stop loss and they will wait for the next day. Okay, they just turn this short term into long term. Maybe it might be the intraday, that might be the some short term swing trade or something. They wait with some some hope, like because it is coming down. Suppose if it is going upside, like making higher highs and higher lows like this. Okay, waiting for such things are okay, but if it is making lower highs and lower lows, lower highs and lower lows, it's pretty hard. Like if it is making like this, lower highs, lower lows. Okay, if they have taken trade here upside, and if it is coming down by breaking lower lows, and they wait with some hope, or like it will come upside, like by turning their positions to long term, short term. Actually their target is this one. They take position here. Okay, they wait the price to come upside to hit their target by turning this to long term, but the price will keep on going downside only by making lower highs, higher highs, lower highs and lower lows, because they don't know the structure of the market, structure of the chart. They don't know the structure of the price, how it behaves, the characteristics of the price. They don't know actually. Okay, don't do this mistake also. When you buy options, this decision to hold loss in intraday positions overnight only exaggerates the loss, as there is constant depreciation of time and premium decay. In option buying, if you are waiting for the next day, in the sense you are in the depreciation of the time, means the premium drops, so you will be in the losing side only. Okay, better to book your profits very quickly if you are an option buyer. Don't wait so long. That's very, very important, because option buyer should be operate in the direction of the market, and whatever the price you bought, the price must hold, means the same levels you bought, and it should go upside. Even if it is trading flat, you will be in the loss side only. Okay, and another important level is theta decay, time depreciation. If time depreciates, premium drops, so you will be in the loss side only. So these 3 points are very important for you to remember always. Okay, every new day and weekend that you hold buy option positions significantly erodes premium. Obviously what I have told you now, the same thing. Okay guys, this is all about option psychology and why many option buyers lose money. Please avoid these mistakes. Okay, the more you wait, the more you lose. That's how option works. If you want to be profitable in the option trading, you must book your profits very, very quickly. You must be smart. You must be good at predicting the direction of the market. Okay, and the levels you must know where to enter and where to exit, and the risk management is very important. The position sizing also very important. How much loss you can take, you must be self-defined. The how much risk you can take is very important. Okay, that's all about psychology beyond buying options, guys. If you like the video, like, share and comment, and please share with your friends. Subscribe to our channel also, and okay, that's all, guys. Thank you.